So if you've already got enough to retire, why are you taking on all of this risk to maybe just try to get a little bit more over the next few years? But you're putting yourself at risk of losing a lot of money at the absolute worst time. Hey guys, I'm Ron Sneller. Thanks for tuning in and taking the time to watch this educational video. The reason that I'm making this video is because I'm seeing this huge disconnect with the average investor and how they're planning and preparing to transition into the retirement phase of their lives. And a lot of this problem has to do with the type of advisor that they're working with. They're working with advisors who are accumulation specialists. They're focused on your working years, building up your money, and they're focused on your average rates of return. And they're talking to you about your net worth. And these are the types of advisors they're charging you a point to a point and a half to manage that money. But what they're not talking to you about is how you're going to spend that money in your retirement. And so the average investor has a pretty good idea of how much money they have. They have no idea what that's going to do for them in their retirement. And so when they come to me, somebody who is a distribution specialist, and they want to know, like, hey, this is the money I have. What am I going to do with this? Like, how am I going to get to spend it? A lot of times I'm able to review their portfolio and say, hey, listen, you have enough assets that you could retire comfortably in, let's say, 3 years. But the problem is you just don't have it positioned properly. You're still taking on risk as if you were 35, trying to build up to get to where you're at right now. So you've been successful. All of this risk, this isn't for you. So if you've already got enough to retire, why are you taking on all of this risk to maybe just try to get a little bit more over the next few years? But you're putting yourself at risk of losing a lot of money at the absolute worst time. So what we really need to do, Mr. or Mrs. Client, is make sure that you don't lose 50% of your money in the next market downturn. And that's the conversation that I'm having with people. So I'm able to show them how I'm able to reposition what they already have so they have no dollars out of pocket and just move their money from their left pocket over to their right pocket, preserve that money, protect it, take it away from risk, and put it into financial vehicles that'll kick off a lot of cash flow because there is no market risk on their money. So I'm creating this video today to give you an example case study of some of my clients that I've worked with. For this video, I'm going to change their names to Jack and Jill and keep their identities private because we're talking about their money. But without further ado, let's get into the case study. So what you're seeing now is what we call our income for life report. This is our simplicity software where we lay out all of your guaranteed income streams. And we keep this as simple as possible so you know exactly where your retirement income is coming from and how much of it is coming from guaranteed sources. Let's check this out right here. We like to keep this nice and easy. We're going to see that when we met Jack and Jill, Jack was 60, Jill was 58, and they wanted to retire 5 years from first meeting me. So 5 years from what we're laying out here. Their retirement income goal, they want to retire on $100,000 per year. And so the first thing we do is we factor in all of their existing income streams. So at Jack's retirement age of age 65, he has a projected Social Security benefit of $25,200. Jill has a projected Social Security benefit of $18,000. And Jack is fortunate. He has a defined benefit pension plan where that's giving him $2,000 a month or $24,000 a year. So with Jack and Jill, their goal is to have $100,000 of income. And guess what? They've already got about 2/3 of that goal covered with guaranteed lifetime income of $67,200 per year. Now, here's the deal. We have what I like to call an income gap. Okay, guys, an income gap. And this is just simple math. We take their $100,000 of their goal, subtract out the $67,000 that they already have. And so they have an income gap of $33,000 per year that they're going to need to solve for moving forward in order to retire comfortably and meet all their goals. Now, here's the other thing. So they have a goal of $100,000, but they also already have some investments. Okay. Between their 401ks and between their IRAs, they have an investment portfolio of about $600,000. Okay. So they do have 401k and IRA. They've got $600,000 in that portfolio. Now, Jack and Jill, because of where they're at, getting ready to transition into retirement, they have a pretty low risk tolerance. They're a more moderate to a moderate conservative investor. And if you kind of take a look at the way that the stock market has moved over the last 20, 25 years, we can see that there's a lot of volatility. And the last thing that they want to have happen is perhaps within their last few years of retirement, that if we go into some other kind of dot-com crash or another financial crisis, or if some kind of COVID happens again, or like in 2022 where their accounts went down 25%, they don't want to take that risk. So they decided that they want that other $33,000 to come from guaranteed income sources. Well, stocks and bonds are not guaranteed, right? But what I said to them is, hey, listen, you may have enough money with your $600,000 portfolio, plus you have a few years left where you can continue to contribute, save, and invest, and hopefully we can get you there, using the industry approved standard of the safe withdrawal rate. And we kind of look at Morningstar at the end of 2023, they just updated the safe withdrawal rate, and it went back to the historical safe withdrawal rate of 4%. Okay. Looking at where their assets are at right now, they've got about $600,000 in their 401k. And they want to create $33,000 of income. Are we able to do it with 4%? No, it's going to take about 5.5% as a withdrawal rate in order to create the $33,000 that they need in order to fill that income gap. So that's substantially higher than the Morningstar safe withdrawal rate. So when we put all of their information into a retirement planning software and ran a Monte Carlo analysis, what we realized is that with their current situation and having to withdraw that much money every year, they only had about a 73% chance of success. And that's something that they certainly didn't want to do, move forward with that. This is a situation where, 73% chance the stock market is probably going to perform for them, probably, maybe. But when it comes down to the ultimate success of your retirement, they said, Ron, we don't want just a maybe. We want a sure thing. What do you want? Do you want a maybe, or would you rather have the sure thing? So if you would rather have the sure thing, keep on watching, because we're going to show you what I like to call our protected pension system, where we're going to use some of their 401k and IRA money in order to buy or fund their own personal pension in order to close that $33,000 income gap and give them all of that income that they need and do it on a guaranteed basis. Okay. So that's what we're going to talk about. That's what we're doing. So, and what that involves, this protected pension system, it's using a guaranteed retirement insurance contract from a large, strong, stable, one of these big insurance companies. Okay. And the product that we use is called a fixed index annuity with an income rider. And a lot of times people have a little confusion over annuities. Well, what's that? An annuity is an insurance product that gives you a guaranteed income stream. And annuities are the only financial product that can take 4 key retirement risks off the table. Longevity risk, because it pays your income as long as you live. There's no stock market risk on it. So that eliminates this withdrawal rate risk that maybe you end up withdrawing. You have to withdraw 5.5%, which depletes your portfolio. And of course, this order of returns risk, or that sequence of returns risk. An annuity eliminates all 4 of these key retirement risks, takes them off the table, and allows you to retire comfortably because you have pension income. It's like you're buying or funding your own personal pension. Now, the question is based on where the annuity rates are at today. Now, remember, Jack and Jill, they're not going to retire for 5 years. 600,000, is that enough money where we can reposition some of that money, put it into one of these guaranteed income annuities, and fill that income gap? After we did our research and our analysis, we found out that yes, we were able to do that, and this is what we needed to do. So what we ended up doing is, out of the $600,000 that they had in their 401k or their IRA, we had to roll over just under $400,000. You're going to see right here that their solution to solve that income gap and solve that problem, they needed $392,000. So we rolled $400,000 out of their IRAs into this guaranteed income annuity. Now, what is this going to do for them? Well, what this is going to do for them is it is going to ensure that it fills that income gap, and that 5 years from now, when Jack wants to retire, whether the market is up, whether it's down, whether it's stagnant, just kind of move sideways, None of that matters. They're going to be able to retire on $100,000 per year, guaranteed, and that money is going to last for the rest of their lives. And this is what we call a joint annuity. So even if Jack died 1 year into retirement, guess what? That payment doesn't go down, it doesn't go away. Jill takes that whole payment with no reduction, and she just keeps on going for the rest of her life. So this is just an absolutely amazing tool to give people the peace of mind that they need, where now these people know that, hey, even if we have another 2008 financial crisis, we don't have to worry about it. We can still retire on time. We're not going to have to work 3 or 4 extra years and give our money a chance to recover. Nope. We're completely removing that out of the situation and adding a lot of predictability and certainty into this scenario so they cannot worry and retire happy. And I'll just add one last thing here as we kind of come to a conclusion of this case study. One of the greatest things that I have learned in my 10 years as a retirement income planner in implementing this retire ready solution into my clients' lives, it's not just about the numbers and it's not just about retirement, but it's also these next 4 or 5 years taking away all of this stress. And I mean, these are people who told me they literally check their stock portfolio every morning to see if it's going up or down. And because we've taken the steps to secure a protected pension, not only do they not have to check their stock portfolio anymore, they never have to tune in to all the talking heads on Fox Business or CNBC and try to decipher all the complicated jargon and all this financial talk. They don't have to worry about that anymore. Okay. Now, remember, they still got $200,000 in their IRAs and 401ks. They'll continue to add to that. We even started them Roth IRAs as well, and they're putting some money in there. But again, with their investment portion of their money, whether we enter the next great bull market or whether we have another huge crash, they know that as far as the investment portfolio goes, they don't have to rely on that in 5 years. They might have to start tapping into that 10, 12, 15 years down the road in order to take some profits and help offset the effects of inflation. But they're not going to have to tap into that anytime soon. And that's a beautiful thing. When you use this protected pension system, it removes the risk, removes the uncertainty, and adds a lot of predictability over the next few years and ensures that you can retire on time and live out your retirement goals and dreams. So guys, if this is something that you want to learn more information about, depending on what platform you're watching this on, there should be a link to my calendar, whether it's maybe down in the comments below or in the description of this video. You can schedule a complimentary consultation by using my Calendly link. It just shows all the availability that I have coming up over the next week or two. You simply pick the day and time that works the best for you. You schedule the appointment, and then it's going to send you the Zoom link and a calendar invite. Now, I work virtually with people all over the country. I've even got clients in the Virgin Islands, Washington, D.C., and currently I have clients in 47 states. But you do have to be U.S. based. If you're in Canada or outside the U.S., I'm not able to help you, and I'm not able to work with you. But I do look forward for those of you who are in the U.S., and you're interested in looking at how would this look for you? Is this a good fit? How much money would you need to reposition and when? Go ahead and book yourself a free consultation. I look forward to visiting with you, and I'm happy to help. All right, guys, thanks for tuning in. I hope it helped. Take care.